let's discuss how to calculate the cost of irredeemable debt. For example, X Limited issues 1009% debentures of the face value of rupees 100 at a discount of 5%. Underwriting and brokerage expenses in connection with the issue are rupees 5 per debenture and income tax rate is 40%. The requirement of the question is to calculate the cost of debt. So now let's write the given information in the question. So how many debentures are issued? 1000 debentures are issued and face value of one debenture is rupees 100. So let's write the total face value of the debenture. Total face value of the debenture is equal to value of one debenture is 100. Then value of 1000 debentures will be 1000 into 100. We get total face value is equal to rupees 1 lakh. Now the debenture is issued at a discount of 5%. So here, let's calculate the issue price of the debenture. The debenture is issued at a discount of 5% and underwriting brokerage expenses in connection with the issue is rupees 5, which means issue price of one debenture is equal to issue price of one debenture is equal to face value is 100 and upon face value we took a discount of 5%. So 100 minus 5, it is issued at a discount of 5%. So we are applying 5% discount on the face value. So 5% of 100 is nothing but 5 rupees minus there is a flotation cost of 5 rupees again. So the total issue price is rupees 90 per debenture, right? So value of one debenture, issue price of one debenture is 90 and we have issued 1000 debentures. So the total proceeds from the issue of debenture is equal to one debenture is issued at 90. So 1000 debentures have been issued at a price of rupees 90,000. So what is important is the face value of the debenture is 1 lakh. But since the debenture is issued at a discount of 5% and the flotation cost is rupees 5 per debenture, the total proceeds that the company received by issuing the debenture is only 90,000 rupees. Now, the requirement of the question is to calculate the cost of debt. See, first, we all know that the formula for calculating cost of debt for irredeemable debenture is I into 1 minus T divided by net proceeds. So in this formula, I represents interest, T is tax, and the net proceeds is NP refers to the net proceeds, which is nothing but the issue price, right? So we can easily solve the question by making use of this formula. But before solving the question using this formula, let's understand it logically. Let's understand it how to solve the question without using the formula, and then we will discuss the calculation by making use of the formula. Now let's solve this question without using the formula. For that, let's take some assumed numbers. So let's prepare the income statement before the issue of debentures and after the issue of debentures. And let's make an assumption that before the issue of debenture, EBIT of the company is, let's say, 1 lakh rupees. And after the issue of debenture also, let's make an assumption that EBIT of the company is same 1 lakh rupees. There is no change in the EBIT of the firm before the issue of debenture and after the issue of debenture. From EBIT, we have to subtract the interest expense. Now, before the issue of debenture, there was no debt in the company. Let's assume before the issue of debenture, let's assume it is 100% equity company. So there was no interest expense before the issue of debenture. But after issuing a debenture, after issuing this 1000 debentures at a total face value of 1 lakh rupees, we have to apply the coupon rate on the face value. Coupon rate is 9% and the total face value is 1 lakh. And we know that interest should be calculated on the face value and not on the issue price or the market value, because issue price will keep on fluctuating, right? Sorry, a market price will keep on fluctuating, but face value will remain constant. So interest should always be calculated on the face value of the debenture, because face value is the value that the company has promised to pay to the debenture holders at the time of redemption, right? So 1 lakh is the total face value upon which we have to apply the coupon rate 9%. So interest amount will be 9% of 1 lakh, we get 9,000 rupees. So when we subtract interest from EBIT, we get EBT of 1 lakh before the issue of debenture and an EBT of 91,000 after the issue of debenture. So before the issue of debenture, EBT is 1 lakh. After issue, it is 90,000. So from EBT, we have to subtract tax at 40%, because in the question it is mentioned that income tax rate is 40%. So 40% of 1 lakh, we get 40,000 rupees, and 40% of 91,000, we get 36,400 rupees. So EAT, or earnings after tax of the company, is equal to 60,000 rupees before the issue of debenture. But after the issue of debenture, the profit after tax of the company is reduced to 54,600, which is nothing but 91,000 minus 36,400. So EAT before the issue is 60,000, but after the issue, it has reduced to 4,600 rupees. Now, why did the profit reduce? Why did the earnings after tax reduce? The decrease in earnings after tax, the decrease in earnings after tax is due to the issue of debenture, is due to the issue of debenture. Let's say if the company had not issued the debenture, the profit after tax of the company would not have changed, assuming EBIT and tax rate had remained the same, which means here before the issue of debenture also, EBIT of the company is 1 lakh. After issue also, it is 1 lakh. Before issue of debenture also, tax rate is 40%. After issue also, tax rate is the same 40%, right? So there is no change in the EBIT and there is no change in the tax rate. So the decrease in profit is caused due to the interest expense, because before the issue of debenture, the company had no interest expense, but after the issue of debenture, the company is paying an interest of 9,000 rupees. So the decrease in profit is due to the issue of debenture, right? By how many rupees did the profit reduce actually? The profit reduced by, before issue, it was 60,000. After issue, it is only 54,600. So there is a 5,400 rupees of reduction in the profit. So second point, let's say this is first point. The decrease in profit was due to issue of debenture. Second point, the profit reduced by rupees 5,400 due to the issue of debenture, due to the issue of debenture. Now here, there is an important point that needs to be addressed. So here, before the issue of debenture, the company was paying 0 rupees interest. But after the issue of debenture, the company is paying 9,000 rupees interest, right? So then, logically speaking, the profit of the company should have reduced by 9,000 rupees. Correct? Because before issue, it was only 0 rupees of interest, but after issue, it is 9,000 rupees of interest. So the profit of the company should have reduced by 9,000 rupees. But here, the profit of the company reduced only by 5,400. Why? Because of the tax benefit, because of the interest expense. The profit should have reduced by 9,000 rupees, but here it is reducing by only 5,400 because of the tax benefit due to the interest expense. So what I'm saying is, before the issue of debenture, interest expense was 0. So profit before tax of the company was 1 lakh. So the company was paying tax at 40% on 1 lakh rupees. So they are paying a tax of 40,000. Right. After issue of debenture, the company is paying an interest of 9,000 rupees. Now, because of paying this 9,000 rupees interest, profit before tax of the company has reduced to 91,000. So due to the interest expense, the profit before tax of the company is less. And because the profit before tax of the company is less, the company is paying lesser amount of tax to the government. To put it simple, this 9,000 rupees of interest is giving us a tax benefit of 40,000 minus 36,400. It is giving us a tax benefit of rupees 3,600. This 3,600 is nothing but the difference between 40,000 and 36,400. 400. So this 3,600 rupees of tax is saved because of paying the interest of 9,000. Now this 3,600 can be explained in other way also, which is nothing but the company paid 9,000 rupees interest. Now because of paying this 9,000 rupees interest to the debenture holders, the profit of the company has reduced by 9,000, right? So now the company can save tax on this 9,000 rupees. So apply tax rate to this 9,000. So 9,000 into 40 percentage. What do we get? 40 percentage of 9,000 is also 3,600. So what is important to understand this? So let me explain it over here. Third point. Let's say the company is here. Debenture holders are here. The company paid rupees 9,000 rupees interest to the debenture holders. Now, because of paying this 9,000 rupees interest to the debenture holders, the company is saving a tax of rupees 3,000 rupees. The company is paying 3,000 rupees less amount of tax to the government, right? So here the net cost for the company is net cost is 9,000 is paid to the debenture holders. Because of paying 9,000 rupees to the debenture holders, the company is paying 3,600 rupees of less tax to the government. So 9,000 minus 3,600, what we get is rupees 5,400, which is nothing but the 5,400 in the second point that we discussed. So the profit of the company is decreasing by only by rupees 5,400 and not by 9,000 rupees because of that tax benefit cost due to the interest expense. So let me summarize it. Before issue of debenture, company was paying 0 rupees interest. So the company had to pay a tax of, the company had to pay 40% tax on 1 lakh rupees. After issue of debenture, the company is paying interest of 9,000 rupees. So the company is paying 40% tax on only 91,000 rupees. So the company is paying 3,600 rupees of less tax, right? And the company is saving 3,600 rupees of tax because of this interest expense. So interest is giving us a tax benefit. So the company is paying 9,000 rupees of interest. Out of that 9,000 rupees, 9,000 rupees is paid to the debenture holders. Because of paying 9,000 rupees to the debenture holders, the company is paying 3,600 rupees less tax to the government. So the net cost of the company is 5,400. So the profit has decreased by only 5,400 rupees and not by 9,000 rupees. So we can say that this 5,400 is the cost of debt. So rupees 5,400 decrease in profit is due to the issue of debenture. So we can say this 5,400 is the cost of debt, right? Now, let's see how to calculate the cost of debt. I mean, in terms of percentage, we have 5,400 is the cost of debt in terms of rupees. Now, how to calculate it in terms of percentage? Now, this 5,400 is the cost of debt, right? This is the cost for raising how much rupee of debt in total. The company raised 90,000 rupee of debentures, right? The company raised debentures worth of 90,000 rupees. So for raising 90,000 rupees of debentures, the cost for the company is only 5,400. So cost of debt of the company is equal to 5,400 divided by 90,000. So we get 5,400 divided by 90,000, we get 6%. So 6% is the cost of debt. Now let's see how to calculate this cost of debt within seconds by making use of the formula. We know that cost of debt of the irredeemable debt is I into 1 minus T divided by NP. Now while using the formula, we can take the value of per debenture, or we can also take the value of the all the 1,000 debentures. It will give us the same answer. Let's take the value of one debenture. So what is the face value of one debenture? In the question it is mentioned that face value of one debenture is 100. What is the coupon rate? It is 9%. So what is the amount of interest that the debenture holders are going to receive for one debenture? Face value of one debenture is 100. Apply coupon rate on 100 rupees, we get 9. So the amount of interest is 9. So the amount of interest is 9 rupees multiplied by 1 minus tax rate is directly given in the question 0.4. Now, listen, why we are multiplying interest with 1 minus t? Because here we discussed the logic, right? The company is paying interest to the debenture holders. Because of paying interest to the debenture holders, the company is saving some tax expenses. So interest is giving us some tax benefit, and that is the reason why we are multiplying it with 1 minus t. So I into 1 minus t, which is 9 into 1 minus 0.4 divided by net proceeds. Net proceeds is nothing but the issue price basically. So at what price the debenture is issued? Issue price of one debenture is 90, which we already calculated. So 9 into 1 minus 0.4 is 0.6 divided by 90, we get the same 6%, right? Now let's look at the first question for calculating the cost of debt. Question number 1. Five years ago, Chandi Limited issued 12% irredeemable debentures at 103 rupees at 3 rupees premium. So 3 rupees premium to their face par value of rupees 100. So to put it very simple, 5 years ago, when the debenture was issued, it was issued at a price of 103. So first, let me write it down. Issue price was rupees 103, which was issued at 3 rupees premium. So face value of the debenture was only rupees 100. So the difference of 3 rupees is nothing but the 3 rupees premium. The current market price of these debentures is 95 rupees. So here market price of the debenture is also given, which is rupees 95. If the company pays corporate tax at a rate of 35%, calculate its current cost of debenture capital. So now first we have to identify whether it is a irredeemable debt or redeemable debt. In this question, the maturity period of the debenture is not mentioned. So it is clear that it is an irredeemable debt. Right? We know the formula for calculating irredeemable debt. It is KD is equal to I into 1 minus T divided by the net proceeds. So here we have almost all the relevant information. The interest rate is, or the coupon rate is 12%, which needs to be applied on the face value, right? Because market value will keep on fluctuating. So the coupon rate needs to be applied on the face value of the debenture. And one more reason is the face value of the debenture is 100 rupees, right? So this face value is nothing but the company has promised to pay 100 rupees to the debenture holders at the time of redemption. Even though it is an irredeemable debenture, the principal amount will be repaid at the time of liquidation, right? At that time, the company will pay 100 rupees to the debenture holders. So face value is nothing but the amount that the company has promised to pay to the debenture holders. So interest should always be calculated, or the coupon rate should always be applied on the face value. So what is the amount of interest? 12% of 100, we get 12 into 1 minus the tax rate is 35%. So into 0.35 whole divided by net proceeds. So here there are three amounts that is available. Here we have issue price 103, face value 100, and the market price is 95. So which amount we should take in the denominator? So here first there is a thumb rule. So let's follow the thumb rule. If it is an existing issue, first preference should be given to market price of the share. Suppose let's say market price is not available. If market price is not available, in that case, we have to take issue price. Suppose issue price is also not available, in that case, we have to take the face value of the debenture. Suppose if it is a new issue, in that case, see, if it is a new issue of debenture, they don't have a ready market price, right? If it is a new issue, they don't have a ready market price. The first preference should be given to issue price. Suppose if issue price is not given in the question, then we have to take the face value. Now, in this question, the debenture is an existing issue or it is a new issue. Obviously, it is an existing issue. Why? Because the question clearly says 5 years ago, Chandi Limited issued 12% debentures. So it is an existing issue. So the current market price is the relevant figure. So 95 rupees should be taken. These are past figures. 5 years before, when the debenture was issued, it was issued at 103. Let's say if an investor wants to purchase the debenture today, at what price he can purchase it? He has to purchase it at 95 rupees. He cannot time travel to 5 years before, and he cannot purchase it at 103 rupees, right? So the relevant figure is 95 rupees. And one more thing, the basic difference between finance and accounting is backward looking, whereas finance is forward looking. So any past information that is given in the question is always irrelevant for decision making, right? So this 103 is a past figure. 5 years before, when the debenture was issued, it was issued at 103. But if an investor wants to purchase it today, he has to purchase it at 95 rupees. So the most relevant figure is 95 rupees. So we are taking the market price. So what will be the cost of debt? 12 into 1 minus 3.5 is, we get 7.8 divided by 95. We get 8.2 percentage is the 8.21% is the cost of irredeemable debt.